exits and targets. So first we'll take the traditional approach. The traditional approach is a geometric approach. So here we have a double top NQ. Now we're looking at a 5,000 or a 500 tick chart here, the NASDAQ. So let's draw in our lines. There we go. So here's our double top, and it pierces it. It's a failed 5, which is great. We love these kind of patterns, as I talked about. We've got a spike top reversal bar here, so that's great. And again, the fact that it pierces just a little bit above the previous high also adds to the probability that it'll go down. It's rejecting the value above this high. And the spike top reversal bar is a pretty good one. It opens and closes well at the bottom of the range, way down there, definitely within the bottom quarter. We want a decent range bar, but again, this is a tick chart, so remember, on tick charts, we don't require that we get the really wide range bars that we do require on time-based charts, just because tick charts, when they get a lot of enthusiasm, a lot of trades coming through, they create more bars rather than creating wide range bars. So you can't expect that. So anyway, but we can still use candlesticks, and they still do create these patterns because the ticks do not refer to volume, so you still get some extreme type patterns like this. You still get some wide range and narrow range bars due to that fact. Okay, so anyway, now here's what we do with traditional technical analysis is we look for the neckline, okay, which is right here. And then we measure that distance. We say, okie doke, so the distance from there to there, we'll use a drawing tool here. This is, we call it a line. Technically, it's called a segment. And so we measure, what we're doing is we're really just measuring the distance from the high to the neckline. Okay, then we're going to take that bar and move it. We're going to move it from the neckline down. Okay, and then I think I got a little extra, little space there. That's all right, it's close enough. Again, all this stuff is approximation. Then we're going to put our line there, and well, there you go. So that is called a measured move. Essentially, it's an equal distance from that high, or from that low to that high, and that's where we expect the first target to be. And this one, well, just happens to hit it to the penny, pretty much, to the tick. Okay, it's not always that neat, obviously, as you know, but you know, the measured move approach is not too unreasonable. It has some merit, and you can certainly do that if you want to. Now, another way to do it, other than doing all of that geometry and all these different levels and drawing tools and all that, that's kind of a lot of work to do, and you're trading intraday. So another thing you can do is you can use your Fibonacci retracement tool, and we can draw that from there to there. Now, what you need to do, though, is you need to pre-configure this so that you have one of these listed as negative 100%. Okay, and we'll keep it at blue, make it a little bigger. Negative 100%. So you put a negative 100% line in there, and then you save that. Oh, you know what? Darn. Oops. Oh, I see what I did. Okay. Well, we can still do this. So, well, you do the negative 100% the other way. I drew this up. You can draw it down. Normally that's the way you do it. But that's okay. We can do it this way too. So let's pull this back up here. So actually, instead of negative 100, what I needed was this 200 down here. And that should do it. Let's just apply it, and there it is. So you can do it that way. Because, see, the reason that happened is we're measuring from here to here. So that's 0. Well, I'm sorry. That is 0 up here. 100% retracement is retracing all the way back down. So when you draw negative 100%, it's actually going up there. Because that's 0, and anything above it is negative. 100% retracement, since I was drawing from that low to that high, is all the way down here. So then a 200% would be down to there. Okay, so anyway, that's another way, and you can just keep your fib tool that way with those parameters in it, and that way all you have to do is draw it on there, and you're good to go. So, and you can also do it the other way, which is how a lot of people do it. Well, yeah, you can do it either way. You can do it from there to there. Okay. And then you can put in your negative 100%. Now it should do it. And we apply. There it is. Okay. So actually, the first way I did it, I think, is a little bit better, just because you are measuring from here to the final high. But again, it's close. All the support resistance stuff is in the zone. It's close. It's not going to be exact, and don't expect it to be. So that's where your indicators come in, your cycle indicator, your candlestick patterns, all that kind of stuff. See, here you get a candlestick pattern that invalidates that one and that one, but it's just a short little cycle low, and it's a little rubber band trade. But see, that's just a small little cycle low is all that is. Candlesticks, that's all they measure. The bigger pattern is this double top, and that actually does end up ending that trend. So that's one way you can measure. Now, as far as targets go, you want to, well, let me just, before I move on any other topic, let me show you how you do the same thing with a head and shoulders pattern. Alright, so here is a reverse head and shoulders pattern. Here's our last cycle low, high, low, high, low. And so we draw our, there's our high, and there's the high. Okay, so we're drawing from there to there, so that's our neckline. 2 cycle highs between the shoulders. That's your lower shoulder, left shoulder, head, right shoulder. So then we do our measured move little thing, and what we do is we go from this low to that. Take that. Now actually, I've seen people do this a couple different ways. One is to do it off of the measured, or just off of that trend line. Other people want to do it right on the at the place where the market breaks out. But in this case, it ends up being about the same thing. The market goes toward it, doesn't quite reach that exactly. And then, of course, our other way of doing it is with the Fibonacci's. And we just draw it from that high to that low. And yeah, does not quite make it there. So I don't really use these target techniques myself. These are, oops, start a spot there. These are traditional approaches, as I said. I don't find them to be really all that accurate or all that helpful. The measured move thing, that does make some sense based on the Fibonacci, so you can kind of watch that and use that as one of your principles if you want to, but basically all I'm looking at is the normal support resistance that we always use, the moving averages, floor trader pivots, previous swing highs, lows, closes, Fibonacci levels would be included in that, and then also the conjunction of a cycle high with that. So to me that's it. Now the other thing that's very, very important and this is what is most important, because the market, it doesn't really move in those geometric progressions as neatly as we would like. Darn, I wish the market was neater. It's not. It's messy. Okay, how many times are we going to say that? But because it's messy, because it's untamed, we need to be extra careful, and that's why money management becomes so critically important. And it's more important than, more reliable. The reason it's more important is because it's more reliable than doing all this other stuff. So this is where we taught our money management program in Foundations Course 1, where we size out of positions. We take 3 exits. The first would be the first, and when we're going along, the end of the first half cycle, first cycle high. Then we wait, and then we wait for the next level of resistance and the next cycle high, and then we wait, and if we still can keep going, then you have some different choices. Usually we use some kind of a trailing stop at that point, and all those trailing stops are spelled out, and you can choose the one that fits your risk tolerance the best. Now on these reversal patterns though, thing to keep in mind when you're doing a reversal trade, the real reason you're doing it is to try to catch a new trend in the other direction. As we said, you may not. There's no guarantee at all, but that's one of the reasons we take it, is so that when the market does actually start a new trend in the other direction, we can get in extra early, and the risk reward scenario will be phenomenal. So it happens less than half of the time. Markets don't normally go from one trend into another. They usually go from order to chaos. So usually in between one trend and another, there's some sort of chaotic pattern. And after that chaotic pattern, there's no guarantee that the market will trend in the opposite direction of the previous trend. It could go back in trend in the direction of the previous trend also. But what we do is we keep a little bit of our position on, and we watch the market, and we see if we can catch a new trend. If the market does start a new trend in the other direction, then we want to stay with that for 3 to 5 waves. Okay? Again, that'll happen less than half of the time, but that's one of the things that we're watching for. And you just really have to watch a lot and get really used to you have to use a little bit of a loose trailing stop on that last exit, because on those trends, with the market going up and down, it will move against your position rather significantly on the retraces. You may get complex retraces in there and so forth. So you may or may not even want to try that approach. You may say, you know what, wow, that's going to be difficult for me. I'm not really sure if I can do that. And it may not be for you. It may not be for you, and that's okay. Just, this is where knowing yourself is important, knowing what style fits your risk tolerance, your attention span, how your mind works, all that stuff. Your nervous system, basically. So I can't tell you, what's right for you. You have to discover that on your own, through your own experience, through observing yourself and your reactions to the various market movements, and determine, okay, am I just built to be a little scalper here and take those little half cycle trades, or do I like to hold on to the longer trades and try to catch those big moves when they do happen, or somewhere in between.